Welcome to Accelerate OC, the only show focused on the people leading innovation in Orange County. Join our host, Carrie Ransom, in his conversations with the trendsetters, entrepreneurs, investors, and leaders here, because it's time to Accelerate OC.
Good morning. Welcome to Accelerate OC. I'm Carrie Ransom, and thanks always to our engineer, Paul, for making me and my guests always sound so good. We are broadcasting live this morning, also on Zoom, and unfortunately not all together, but this has become our new normal, but hopefully for not too much longer. Today's episode is sponsored by OC4 Venture Studio, where I am sitting here today, and it's a new tech startup company building platform and community that we're building here in Orange County. So if you're looking for help with your startup, or you're looking for opportunities to work with the next generation of high growth companies, or you want to be part of the Orange County startup community, you can visit us at oc4v.com to learn more. We'd love to hear from you. I'm excited to have my friend Carson Lappetito here on Accelerate OC this morning, and very, very timely for him joining us as well. Before we get to hear from him and his work as president of a local Orange County bank, which is all the rage these days to be finding your local banker to talk to, let me tell you a little bit about Carson. So he's currently the president of Sunwest, which is our Sunwest Bank, which is an OC-based business bank. And I believe it is celebrating its 50th anniversary this year. And so we can talk a little bit about that. But it was started 50 years ago, really by a group of entrepreneurs, for other small businesses here in the community. And they've been super active in Orange County, working with businesses that range from startup businesses like many I've been involved with, all the way to multinational corporations. He's also really innovative. Part of why we've become friends, I think, is he's very innovative in how he thinks about the banking industry and particularly technology in it. And he even was one of the first to roll out an online application for this recent Paycheck Protection Program, or as everybody now is affectionately calling it, the PPP. And he was really ahead of almost every other bank in the country. We started talking about this almost the moment that it was announced, because he had most of what he already needed to do it built. And so we can talk about that as well, and how the bank has really responded to this current crisis in the small business community with regard to funds and liquidity, and trying to roll out this SBA program. So Carson's a banker, as I mentioned, but he's also an entrepreneur. And I laugh because often those two things almost run counter to each other. I think most people that know people in the banking industry look at them as somewhat the antithesis of entrepreneurs, but I really can vouch that he is one. And he's worked in a number of different roles throughout several financial institutions. He's also an investor in other businesses. He was part of a hedge fund that was focused on investment opportunities in the financial services industry. And like me, he's a transplant to Orange County. And he also showed up here with his economics degree, like I did. But so we're kindred spirits in that regard, but he's way smarter. He also got a degree in political science and even a minor in Mandarin. Carson, it's great to have you on Accelerate OC this morning.
Carrie, thanks for the kind comments. It's great to be here. Looking forward to the show.
Awesome. Well, let's get to the starting line, and obviously the pressing news of today with regard to businesses and the banking system. So how are you guys, let's start first with just how are you as a business and as a bank navigating COVID-19 yourself?
So we have the fortunate benefit of having a pretty diverse board of directors, and one of the members of the board of directors, his family's from Wuhan. And so in February, we'd been tracking this since December, but really in February at our board meeting, we had a pretty significant discussion on what was going on in China, how it was going to evolve. And as a result, we were ahead of the game here. And thanks to, my wonderful team at the bank, they had our pandemic plan up and running in the third week of February. And we were navigating this day by day, up until obviously the state of emergency and then the stay-at-home order from Gavin Newsom, and that really escalated us further into this, pandemic plan. As banks, we're an essential business. I'd argue we're even more essential than the grocery store because you need your money to transact on pretty much your day to day, which means we knew we had to be up and running with every facet of our business. We have a very large transaction processing business that banks a lot of significant companies throughout the country. And as a result, the checks have to get processed by our lockbox. They have to run our ACH transactions. And so in addition to that, we needed our branches operating for the local community. So we put social distancing processes in place for our branches, but we didn't close lobbies like a lot of banks did. We wanted to make sure that our clients still felt like they could come into the bank whenever they wanted and get their money if they needed to. And that's an important level of confidence that our country and our clients have to have in a moment of crisis like we're in.
Sure. Great thoughts. Yeah. So let's talk about the programs, right? I mean, people in a lot of your client businesses are challenged. We were talking off the air. Very few businesses, in fact, none that I've ever met, have modeled for a scenario where they are losing 80% or 100% of their business overnight. So obviously this stimulus that was passed was designed to try to help people just navigate through these uncharted waters. How are you guys responding to that for your clients? I mentioned the PPP as one example.
Sure. So, my heart goes out to entrepreneurs, both my clients as well as friends and entrepreneurs I don't know across this country. You put your blood, sweat, and tears into building a business, and then you wake up the next day and you can't open, and you have your whole payroll and all these people that you're loyal to, that you've been, keeping their families moving for decades in some cases or years, and then all of a sudden to wake up and have to stare at, how do I pay these people when I have zero revenue coming into my business? And I've had phone calls with all of these folks, and the painful decisions they're having to make is just, I can't fathom it. And so, I'm really happy that the government stepped up and put a program in place to keep people employed. I mean, when you think about all the ways the government generates stimulus, to roll out, it was a very thoughtful program that was rolled out. And, look, all big programs that are rolled out quickly have their flaws.
Sure.
But to have a program that keeps people employed for this interim period of time, so that all those businesses are up and running, the day we decide that we're going to open the country back up, and they can begin servicing just like they were a month ago. That's really important. If we don't do this and don't get this money out the door, we're not talking about 10 million unemployed. We're talking about 30 million plus unemployed. And those numbers you just don't come back from as much as you wish you would have this V-shaped recovery, which we'll talk about later.
Sure.
And so, the PPP program it's well thought out, and in my opinion, and the distribution network was well chosen. You have to run it through the banks because they're the only mechanism that has, one is entrepreneur, you're a business, right? So you're entrepreneurial, you can build your own processes the way you want them. But in addition to that, there's problems with the disaster relief program, which we were talking about off the air, where the SBA actually processes those applications, and they aren't staffed to deal with the volume, right? That program's designed for a hurricane in one area, or flooding, or a tornado in the Midwest, for one regional pocket. They're getting applications from all over the country at once. They just can't handle it, where the banks are well positioned to do it. But there's a whole slew of issues that are getting vetted through in the, last week, and it will and as we're ongoing this week. And so, I'll close with saying one of the reasons why we were in front of everyone on this, or almost everyone on this, is that, we had a pandemic plan up and running. We were ahead of the game in terms of how we get this company structured because of the amazing team I have. And as a result, we were a week and a half ago less worried about how do we run our business, because we had already stabilized from that standpoint. And we were sitting there saying, how do we go and serve our communities? Because that's the most important thing right now.
Sure. Yeah. And I think the couple of things on that. I mean, one is, when I heard about this program, the entrepreneur in me said, hey, I've been in the fintech world. I mean, my last two startups have been digital financial transaction, one lending, one banking. I get this world and said, hey, the government's going to need help to do this. And other than you, I don't know many banks that are equipped to actually roll out a scalable online solution for something like this. So I'm sitting there thinking, hey, maybe there's an opportunity for a new entity to emerge. So even as you're thinking about it, I mean, this is somewhat a time to shine and to show customers or even prospective customers, hey, we understand the future of technology. So how has it been from the standpoint of talking to businesses? Because the timeliness of even getting these processed and getting money to people is critical, because they needed it 2 weeks ago or a month ago, not 2 weeks from now. And I think one of the big things getting exposed is that a lot of companies, particularly your local small businesses, don't have months of runway to navigate this.
Mm-hmm. Absolutely. So as a company, as you mentioned, we had a lot of the infrastructure being built to move to a more digital process in a lot of different channels of our business, and a lot of it was up and running, but we weren't putting a lot of throughput through it because we're a high touch, white glove business bank in our communities throughout the Western U.S. We don't drive volume, but I was trying to
until now.
Until we had more applications yesterday than we had as new clients all of last year, just to put it in perspective. So going back to your question about the program and how to get money in the business's hands. I mean, the problem that you're in the midst of is one, banks universally have come out and said, we're only going to take care of our existing clients. And if you read the press releases from the big banks, and I feel for Wells because they're in a tough spot. Yes. If you read the press releases from the big banks, they're really only taking care of their existing lending clients.
Yeah.
And so, when there's every business needs this assistance, it's not just the businesses that borrowed from the banks and now need assistance in paying their loans back to those same banks. So there's, there's a lot of different incentives across the board, as there is with everything. And that's why we came out here and said, look, we're going to do it for our existing clients and new prospects to the bank, because everyone needs help. Mm-hmm. And, we want to build relationships with those that we're helping, because that's, look, we're there in their moment of need, and that's how you build long-term clients in all businesses. And so that's the strategy we've taken.
So let's take that, obviously potential there for you to really establish yourself with new potential clients. How do you think about that, though, from a viability, when it is pretty unclear what demand is going to look like on the other side? I mean, as you're forecasting the Orange County or the economy for your clients, let's say, which is, I think, mostly centrally here, but a lot of them operate in places far beyond Orange County. How are you forecasting the economy for I wouldn't even say Q2, because I think most of us know that's going to be horrific, but call it the second half of this year. And I mean, as a bank, that is a critical function in trying to forecast what capital ratios and things are going to be for your clients, given really, and I think demand seems to be one of the big things that's uncertain, but I'd love to hear your thoughts on that.
Sure. So one of the things that is different about Sunwest is we're an uber conservative company. So we're privately held, very closely privately held, and we operate with excess capital, excess twice the reserves of the industry, mm-hmm. and we're very conservative underwriters. So our clients have excess liquidity and can carry their assets for an extremely long period of time, and that's why we've been here year in and year out. And we've become a regional bank over the last 12 years, because in 2009, we didn't, in 2006, 5, 6, we didn't make the mistakes other banks made. And then we bought 5 failed banks in 4 years and expanded throughout the Western US. And so, we go into this much better positioned than I think a lot of our competitors, which is why we can be more on the offensive than they would be with this, helping the community with this product. Mm-hmm. But I'm extremely concerned about what the future looks like for the economy. I think it's unreasonable to believe that everything will go back to normal when we come out, when we all of a sudden open up. I think when you look at why recessions occur, right? Recessions occur because some part of the economy stops spending, stops investing in their business, and then there's a wave that moves through the entire economy. And recessions significantly happen in the U.S. when the consumer contracts, because U.S. GDP is driven 75% by consumer spend, and the rest is largely by business investment. So when you're thinking about the fact that you had, we had 6+ million unemployed filings last week, right?
Unfathomable.
The highest ever before that was 700,000.
Mm-hmm.
The week before that, you had 3 million, right? So the numbers you're talking about are astronomical. And you're not even taking into account that April 1 was the next payroll sector. So if you have 8 more days till the next set of payroll, and you're going to have a lot of cuts that have already happened and are going to happen between now and then. So you're looking at a very high unemployment number.
Mm-hmm.
Mnuchin said 20%. You're probably going to get there. And no one's ever paused the economy before. So the repercussions of what unfolds in the next month, 2 months, 3 months, you can't even predict, because there's no data points for it. Mm-hmm. And I'll tell you the things I'm seeing, right? All the businesses who can't operate and have had revenue drop by 30, 50, 70%, they've obviously not paid their rent. Mm-hmm. Some have paid for April, but most aren't, or they're paying some portion of it. They're renegotiating all of their contracts right across the board. So you're at the very beginning of a ripple through of revenue through the entire economy. And I don't think it's going to come right back. So you're staring at a bad recession, at best, I think. And it could be worse.
Well, and I think the one other big thing that this starts to really highlight, that is starting to get talked about a little bit, but we've seen just this massive explosion in the gig economy in the last several years, and a lot of people that have a different type of classification. And so it just seems like a lot of our government statistics and measurements are still rooted in this manufacturing industrial era of mm-hmm. 50 years ago, when the bank was starting. And we have to figure out how to have, in my opinion, how to have the systems and the measurement to really understand what is the true economic reality of these various different types of people. In some cases, they're probably healthier than we think, and in other cases, far, far less, because the old hourly wage, everyone had a pretty similar economic reality. I mean, 2 generations ago, 50 years ago, cost of living was pretty stable in most parts of the country and pretty similar. And now it's wildly different if you're where we are here in coastal California versus somewhere else in a small town in the middle of the country, like where I came from. And so I just think there's so many differences that aren't fully reflected that we have to figure out some better ways to handle. So any thoughts on that? I mean, that's sort of my segue to starting to think more about financial technology beyond just faster transactions. But it just seems like we don't have a well understood picture of our economy. Like you said, I mean, we certainly have no precedent for just completely pausing it and seeing demand for things like gasoline drop by 50%, or see demand for travel drop by 90%. I mean, September 11th, we had a little bit of that for a short period, but it is unprecedented. So it's really hard to figure out where we go from here, because a lot of things people believed weren't structurally broken before this.
Mm-hmm. It's look, government statistics have been lagging for quite some time. I mean, GDP is a very bad predictor of growth. And you're absolutely right on how you report employment. And, you know, look at Uber and Lyft drivers. I mean, Uber and Lyft drivers are great examples of the fact that there's just no volume going on. And candidly, there's probably going to be limited volume in ride sharing when you come out of this, because people are going to be concerned. We've created so much fear in our society that people are just going to be more hesitant in terms of their transit choices. And, you know, and I think, look, after September 11th, we didn't realize it at the time, but so much of our day-to-day changed if you travel, right? Just think through security lines. And requests for IDs and you know, inspections of purses, like through every stadium. Think about all those things that changed. This is going to be no different. We just don't know what those changes are.
Exactly what that's right.
Yeah.
That's right.
You know, the most interesting thing I'll say about, you know, the government statistics were one thing that you're talking about, but, you know, I'm not sure most people think through how much money flows through a system because they don't see it every day. But, you know, we were talking about yesterday, I mean, the reason why these landlords can't pay rent is because, you know, a hardware store can't go pay their landlord in shovels for their rent. And, you know, so much of these retailers and hardware stores, you name it, have their their value tied up in their inventory and or accounts receivables that they haven't collected yet. They have to turn that into cash in order to be able to pay their landlord, their bank, etc. And what's happened when we pause the economy is nothing's getting converted. I shouldn't say nothing. A far less significant percentage is getting converted into cash. So now you just have a total stop. Yeah. And what I don't know, what no one's ever seen before, right, outside of some wartime scenarios, is when you turn that all back on, what does that do to prices? What does that do to inventory? What does that do to supply chains? No one really knows. And there will be some huge winners and some huge losers. And then there's some huge winners that no one thought about. And just, it'll be a fascinating study that they're going to write about for decades, if not centuries to come.
Yeah. Well, just think about all I've thought about all the habits that are getting formed right now or unformed right now. Yeah. And those will be things that will help influence some of those changes in winners and losers, like you're saying. So let's go a little deeper in the topic of your industry. So as I was mentioning earlier, you know, the last couple startups that I was deeply involved with were in the financial services industry, or what I know you lovingly call fintech. I don't particularly like the word, but, you know, I'm just kidding. I know it's not a word you adore. So, you know, I'm pretty active. I'm advising several startups in that world. I'm invested in several other startups in the fintech industry. So as someone inside a bank, you know, for all the outside folks that I'm involved with, how do you think about disruption and technology from that world?
So I'll start with that. I really dislike the term fintech. And I, you know, 10 years ago, fintech was an okay term because the universe of financial technology was so small. You know, 20 years ago, you called NCR a financial technology company, right? So yeah. I think you have to break it into what it is, right? You have online lenders, you have online deposit platforms, you have broker dealers, you have payments companies, you have reg tech, and you have neobanks, and there's a handful of other niches, but those are the big ones. And I think there's going to be a lot of disruption that goes on in that space, you know, and maybe the fintechs are going to get disrupted here by some incumbents because of what's going on in the capital markets, which we can talk about after. I think I think the online lending space is hugely flawed. And I'll go through each one of these, but I think there's huge flaws in online lending. And I say that because these folks have built huge, these underwriting models that they fundamentally believe in, and billions and billions and billions of capital have been put out based on these models. But, Lending Club was started in 2006, and the amount of money that went through the 2008-2009 financial crisis was so little that the asset class, you could just assume the asset class didn't exist. So you have no idea what the loss rates on unsecured online originated paper is going to be in what I would say the cycle that just started. And so, I think you have to have at least one more credit cycle in these models before you can accurately predict what the loss rates are and then adequately price the risk. And so I think a lot of these guys are going to get blown up, and I think that the capital markets are going to be taking huge hits. And I plan to put my money where my mouth is when it all cracks, not with the bank but with other investment vehicles, to buy the paper at cents on the dollar, and then because the same way the home equity world blew up. So that's where I think that ends up.
Okay.
And I think it's starting now. The deposit platforms are, I would say the deposit platforms are probably the most interesting to me in the banks, because, look, in life, it's important to know all of your see your own weaknesses, right? The fintechs and the online deposit acquisition and online lenders, they're really good at customer acquisition, right? Banks are really bad at customer acquisition, right?
I didn't know until I got into this world, just as an example. I didn't know how poorly banks were at things like products per customer. That the idea of cross-sell, upsell, and other things were just such a foreign idea. It seemed so natural. I think partly, I grew up in a small town, as you know, and there weren't a lot of choices for banks. So if you needed banking products, you sort of just went there and got them. But I think the explosion of options has really eroded that sense in some of the traditional institutions. So yeah, it was a surprise to me that it wasn't an intuitive part of most banks' strategy until now.
Well, and they talk about it, right? Banks talk about it all the time.
Yes.
But what happens is they have antiquated systems, and they have poor ways of tying customers together. And so what happens is they don't have data engineers inside of their company.
Sure.
And so when they go to cross-sell, they don't know who to cross-sell to, and they don't know how to serve the ad up, and they don't know at what cadence, and they don't have the data analytics to figure out when someone's going to make a buy decision. So they end up just overflowing customers with product. And as a result, when you have too many choices, you don't make any, right?
Yeah. As my friend says, the confused mind says no.
Yeah, exactly. So that's the problem that the banks live in. And, I'm not popular for saying this, but, the core processors, the oligopolies of Fiserv, FIS, and Jack Henry are a huge part of the problem. And unless you have your own technology team to build your own stack in the back end, you're never going to get ahead, because you basically have a commoditized technology platform with zero customization. So you're just like everyone else.
Sure.
So anyway, on the deposit platforms, they're really good at customer acquisition, and they build these niche products, right? And banks who have been successful, like Live Oak's a good example of it. They build niche products, and then they go at the market, and they cater to their customers, so that the customer understands that their bank knows the industry they're in. We look at niche verticals the same way. But the issue that the deposit platforms are going to have right now, and this is why I think there's a lot of opportunity for banks who know what they're doing, is that those companies made their money in two ways. They made their money on the banks paying them interest for the deposits, and interchange fee income from card transactions, debit card transactions. And the problem that that the financial technology space has, largely online lenders, deposit platforms, and the payments companies, is they still have to run through banks because we have the key. The charter is the key to the kingdom, and we can go to the Federal Reserve. And so without that, those companies have to park their money with us. They're generating their revenue off of relationships with us. And when interest rates go to zero, like they did this past month, there's no incentive for us to pay them any interest on the deposits they have with us. And then because fee income becomes so important for banks when they have a tightening net interest margin, the amount the banks will share for interchange to the deposit platforms is going to shrink. And so I see a decreasing revenue stream for those in that space that were generating revenue. At the same time, you have a tightening VC investment world, and it's going to be this, you're going to see the haves and the have-nots emerge really quickly, I think.
Yeah, makes sense. So as you think about that interest rate environment, just as this is something that just sort of occurs to me. I mean, do you look at over the last 20 years and say, okay, this is probably the ideal interest rate environment for all people, right? Savers to earn a fair return on saving, because obviously right now, and I think this hasn't been talked about enough, that with low interest rates that we've had for a long period of time, we've seen a lot of people not incentivized to save. So they've looked at better alternatives for yield, which could have been buying fractional loans on a platform like Lending Club, or could have been going into the stock market looking for dividends. So, in some cases, not fully understanding the risk that they were undertaking as well. So if you think about that from the customer earning a fair return, the bank earning a fair return, to your point, fintech innovation getting a fair return. I mean, what do you think a core interest rate environment that actually makes sense actually should be?
So I'm going to flip this around on you.
Okay.
So I would say that one of my biggest issues with the Federal Reserve and the central banks, both in the U.S. and globally, is they have this mentality where they're trying to create an interest rate, right?
Exactly.
So they're basically, historically the Federal Reserve could control the short end of the curve. They rise it, they lower it, and the market controlled the long end of the curve. Mm-hmm. And so when there was fear, or people thought interest rates were going to come down, they bought on the long end of the curve, the 10-year Treasury. Mm-hmm. And when they thought that inflation was coming, they would obviously sell the 10-year Treasury and the yield would go up, right? So since 2008 and quantitative easing, or I should say 2009 and quantitative easing and Ben Bernanke, the world now has this opinion that we can control. There's this optimal interest rate. The reality is in my opinion, the optimal interest rate is driven by fund flows. And so when you have excess savers, right? So we're in this. Most people don't. It's sort of
cause and effect, like which drives which, right? I totally 100%. Get your point. Totally get your point. But I feel like the Fed has sort of established itself as we're going to be a cause.
Yeah.
Right.
Yeah.
I mean, and I think to your point, yeah. So
and we're actually in this very interesting paradigm shift here, which it's not exact, but 2020, 2021 is when the baby boomer population starts to net draw down on their retirement. That may be delayed because of what just happened in the equity markets, and people may work for a couple more years. But there's this paradigm shift in the US where you're going to have savers drawing down on their money, which means that demand for debt, fixed income, in aggregate will decline, which should drive interest rates up. Mm-hmm. But the Federal Reserve obviously is very much in that market, controlling that. Mm-hmm. So the fund flows are going to be very interesting over the years to come. And the other nuances you have to be looking at is, China's experiencing some major economic contractions, and there's one of their large sources of liquidity, right? If the secondary market borrowing markets are closed, which they are right now, we can talk about capital markets later. Their source of liquidity is U.S. dollar debt, right? And Saudis, right, who have oil in the fluctuating in the 20s, they have investments in US dollar denominated assets that need to be sold in order to generate liquidity to cover their budget. That problem exists globally because you have so much debt in the system, and now you're having, a massive supply shock. You're having a massive demand shock, which means people need to go into their reserves to keep their countries running. And that's going to create really interesting issues in debt markets. So that's my long answer.
Yeah, we probably need to do a panel
we can do a whole
discussion just on, I get a couple. I had Wallace Walrod from the Orange County Business Council on last week, and we had a good. So we'll get a few people together, and maybe that's a follow-up conversation.
Yeah,
for sure. So let's go back to Orange County. We talked about these different categories of financial technology innovation, and you brought it down. Certainly a layer below fintech into some of these categories. But how do you think about Orange County in the realm of and I'll use the word just for simplicity, but as a center for fintech innovation?
So, I see 3 hubs in fintech innovation in the U.S. From my lens, and it's in New York because it's New York, right? That may change after this because I don't think a lot of people want to live in New York anymore. You have Southern California, and then I believe Salt Lake City is going to be a big one that's emerging. But so going to the OC, OC is right in the middle of Southern California, sandwiched between LA and San Diego, and all 3 have their own innovation hubs. And and I think through Orange County, one of the things that's different from it than LA and even San Diego, right? San Diego has this biotech focus. LA has a bit of fintech, but they're really an entertainment shop. Orange County's been this hotbed of mortgage for, so many years, right? And so, and this is why I don't like the term, fintech, right? What companies in Orange County that are big mortgage players have done, they've fully automated that whole application process. They've created huge amounts of innovation in the mortgage space, but people don't call them fintech. Sure. And so I think the combination of the heavy financial services business here, the degree of technology folks we have here, as well as the experience in a deep experience in the mortgage space, which is the most commoditized lending vertical, and as a result has the most innovation into it. There's a lot of unknown tech talent that sits in the back shop of these companies that can do great things in the fintechs, quote unquote fintech space outside of mortgage, right? And so I think you have all the ingredients.
Well, we didn't talk about, you mentioned things like RegTech and neobanks. Do you think of those as places that entrepreneurs here should be thinking about?
Yeah. So well, I'll go to the one I didn't mention, which is my favorite, is payments. I mean, I think the payment space is completely overlooked by banks, right? When you ask me the question of where should banks be focusing, sure. I think banks overlook the fintech payment space. But on the RegTech side, I mean, you've got a huge amount of efficiencies that have to get gained in the bank space that, the RegTech that the banks can't develop themselves. And so you have this captive audience that needs to drive efficiency, yet there's very few service providers in the space that can do that. And so there's this huge demand of a buyer of a service that has recurring cash flow that can afford to buy these services. And I don't think there's enough entrance in sort of regulatory technology because it's just not a, shiny space, if you will.
Sure.
Yet it has huge upsides that I think a lot of people are missing.
And should people think about that from the standpoint of this is what enables the banks to say yes to innovation because it's safer when things like regulatory technology is implemented within it? Or how do you think about it, particularly for use case? Is it risk management, compliance, things that help move forward in a safer or more trusted way?
I think that what it is it's just sheer efficiency, right? So banks typically throw people at compliance problems because people who manage compliance divisions grew up in compliance and they trust paper, not technology.
Sure.
And so what you can sell that product on two avenues, right? You need less bodies. And then second is technology doesn't make errors like humans do.
Sure.
And so as long as you get it built and vetted and right up front, you know, if you make a mistake, it's going to be systemic, but you're not going to have the one-off mistakes that you typically have in compliance that result.
Yeah. Totally makes sense. I like to think of it as managing manually to exception versus the to the rule, right? I mean, and I think that is a mindset shift that a lot of folks really struggle with is, you know, oh, I only have to look at 1 or 2%. Wow, that seems very uncomfortable. But that's probably what it should be. So you work with a lot of companies here. You've been in Orange County for a while. As you think about Orange County as a place to do business, to be an entrepreneur, how do you think about that?
So I'm going to start with the biggest downside. It's in the state of California. You know, and there's two nuances there. The first big one is the regulatory environment here for employment, and then the litany of things, privacy, all the rest. It's just onerous and changing constantly. And so as a result, it's very hard to operate. If you're a nimble technology startup, it's easier for us. We have, you know, staff to deal with that.
Sure.
The second issue is the cost of living in Orange County. It's just expensive. And so getting talent here is difficult, although, you know, once you're here, it's a, you know, wonderful place to live. I think the other big flaw, and this is something that you're tackling head on, the other big flaw is Orange County is a big place, right? 3.2 million people spread out across a lot of different communities, and drive times are long because of traffic and all the rest. And you know, conglomeration economies and where you build sort of tech talent, right? If you look at the Silicon Valleys, you know, back in the day, you want something that's easy to get around. You want those ideas times ideas equal logarithmic ideas, right? That's how great companies, great communities are built in this world. And I think one of the problems with Orange County is it's this huge place where, you know, Silicon Valley is called Silicon Valley, but it's Mountain View and it's Palo Alto, right? And recently it's become more than that. And so, like what you're doing in Costa Mesa, where, you know, people can live closer to that office, it can be cheaper cost of living. The commercial facilities are lower cost, even though they're still expensive, and everybody's going to the same coffee shops, same restaurants. Creating that conglomeration, I think, is super important, and that's one of the things Orange County's innovation world's got to get better at, because right now everything's spread out. And I'll plug I live in Tustin. Love that community, and you know, downtown Tustin is totally walkable, right? And very, very much lower cost commercial office space, much lower cost housing, and that's one of those pockets in our local economy that you know, really could build a tech community.
Sure. And it's very central to everything else too.
100%. And Sunwest was founded there, so you know, you got that plug too.
Yeah, that I think that's a great point. I mean, what are the things from your perspective that you think we as a community could do better to foster more entrepreneurship? I mean, one of my big platforms has been that we're not getting enough starts of the kinds of companies that can have the type of economic impact that you were describing, like a fast-growing, innovative company that was born in Boston or Silicon Valley or somewhere else. We have some of those, but we're not getting enough of them, right? We have a lot of entrepreneurs that take a more lifestyle approach, and we need to produce high-wage innovation jobs. It's sort of for me, you know, the economist in me says, on a supply and demand, you just got to get a much bigger supply of high-wage jobs, and the people will come. The people that are here will take them. The people that want them will come here, but that we have to create that. So what, from that perspective, I guess, what things do you think we could do better?
Well, one, unfortunately, I think the success of Orange County is going to, be determined by how the state of California deals with regulation. And if they don't reverse course at some point, I think they'll continue to have businesses leave just because the business environment is so bad here and gets worse by the year, if not higher frequency than that. With that, said, I think it comes down to traction, like anything, right? And you need more businesses starting here. You're having those trends. Look at Andrew that was started, they reload here and is building a defense company in the middle of Irvine.
Yeah.
So I think that's starting to happen, but we need more wins. And one of the things that holds us back in Orange County, and look, these are a lot of my clients, is we have a big real estate economy here, and real estate's sleepy, and it moves differently than the community that you're talking about building. And I think
it doesn't have the job multiplier, right? It has ephemeral jobs on the construction side, and it doesn't really have a lot of great jobs on the asset management side. And in many cases, those are getting exported because the capital's gotten exported out of California into other markets. So it's really more of a wealth management play than anything. And I think part of what we're really several of us are trying to appeal to here is say, look, some of that wealth needs to get reinvested into more productive industries for job creation in this area where we can win.
Yeah. Well, and I don't know if I'd phrase needs to be reinvested, because capital is going to allocate to where capital wants to allocate based on return profiles and risk tolerances. But I think I think you're early in what you're doing here, and I think but it's absolutely necessary, right? And so it's got to start somewhere.
Sure.
And it's got to build the traction, and I think with continued wins and more people seeing exactly what you're doing and more capital getting allocated, and that just feeds on itself over and over and over again, that's where you get traction and people start recognizing, hey, I should probably be investing in things like this, as opposed to buying that next building, or I buy a slightly smaller building and I start investing in some of these technology firms to diversify.
Yeah. Or be the butts and seats in my buildings.
Yeah. And then there's great companies here that are in the technology and the real estate space. Like I'll plug Michael Wong at Janea, who, has a great company, and, and he's servicing the big local economy here from a technology perspective. And so more wins like that just feed on themselves. And that's what I think, it's a long road, but it would be a great one for our local economy if we can execute on it.
That's right. So a couple more things. How do you just, you're always out in front on a lot of things. How do you keep yourself sharp and really stay innovative in what many people would look at as a fairly sleepy industry of banking, even though it's not? But how do you stay ahead of things?
So never stop learning. As humans, we were given this wonderful thing called the brain, and it's like a muscle. If you don't use it, don't keep using it, it will get stale. And so literally I consume so much information, as much as I can possibly consume in a day, and it comes from every source. And I think that gives you ideas, and candidly, you just need to surround yourself with people that are smarter than you, right? If you do that, you will ultimately be successful.
It's super easy for me.
There you go, man. And then the other thing I'll say is, you've got to be positive, right? And one of the things, and this goes to the environment we're in today, right? I try to wake up every day and eat the day today better than yesterday. And you start a day and you never know where it's going to go and what you're going to have to overcome. But as long as you say, I'm going to make today better than yesterday, you incrementally improve. And it's like any business, right? Businesses are built hour by hour, day by day, game of inches, if you will, for an overused NFL phrase. And, it's that incremental growth that creates long-term success. And we're no different as people.
Yeah, I think it's great analogy and great perspective. So Carson, final lap, one of the things I always like to ask my guests to do is leave a final thought, lesson, piece of wisdom that they have for my audience. So if you think about entrepreneurs here, people that are trying to help make a difference, they're trying to put themselves out there and be bold, and I have a feeling we're going to see a tremendous surge in them coming after this, maybe out of necessity, maybe they're inspired through this time. But what thoughts do you have for the entrepreneurs in the audience?
So I'd say never give up, but always be willing to pivot. I have perseverance engraved on the back of the watch my grandfather gave me, and it's there because it's the core ingredient in success, in my opinion. And I think you have to drive through everything, and I'll just say, as a country, we have to persevere through this, and just keep going. And the other thing I'll say is, so there's two others I'll add. Everything in business and in life is about perspective. How you choose to look at a situation defines the decisions you make through it, and you have to be very thoughtful about your perspective. Because if you take the wrong one, it can multiply in the wrong direction. If you take the right one, it multiplies in the other direction. And the last one is, and it's my favorite, it's always be curious. Curiosity is the mother of invention. And that determines success in addition to perseverance in most cases.
Yeah, those are all so good. Thank you so much for joining. I know how busy you are with this craziness around this PPP program, and you're always busy anyway, but I really appreciate you joining, sharing your perspective, your wisdom. It's always amazing to me. I won't let the audience know, but you're wise beyond your years. And thanks for helping all the businesses in this community at a time where they desperately need it. Not just your clients, not just your credit clients, but being open for business to really anyone here. I think that means a lot. It shows the character of you and of the bank, and the kind of people really looking out for Orange County and its future. As I look at it, you're definitely doing your part and then some to accelerate OC. So thanks for joining.
Thanks for having me, Kerry. I really appreciate having me on. And I'd add that any of the businesses out there that are looking for a PPP loan, come to our website, applications on the homepage, and we'll take care of you.
Awesome. Thanks for joining. We'll talk soon.
Thank you.
All right. You're welcome.